Hello guys, welcome to the Trading Parrot into another elite trading shop live streaming. We're going to talk today in this third episode about a combination of topics that we cover in the past Thursday, and we're going to also introduce new topics. This week we're introducing risk management. Let me show you the initial slide. We are doing this series of workshops as a request from the community. Typically we do TA on Thursdays privately, and we invite all our elite members to be asking for the coins they want me to do TA. But recently people have shown more interest into learning setups and having some more educational, more technical 1 hours. And we do this on Thursday, and you can always join as an elite member if you want to be part of this. I got my community here in the chat, and feel free if you are an elite member to stop me when I'm explaining anything. If you want to ask me about your own setups or things you've been doing and you want my opinion, that is basically one of the main perks of being an elite member. On Friday, this video is going to go live publicly for free to everybody, and that's the way we do it. So if you're watching this on a Friday and you want to be part of one of these sessions live and have this, one-to-one kind of conversation, you can join us an elite member. So let's get started. Let's wrap up where we left last week. So last week we were talking about liquidation pools, and we introduced a little bit the order flow and order book, primarily using Hyblock Capital, Trading Different, Glassnode, and a bunch of other advanced kind of data. We have a big discussion on, what's the added value on top of TA of having this extended set of data points, metrics. And I think it's a good thing to add, as long as you already conquer the TA, okay? Don't skip TA and go straight into data. I would say one step at a time. Last week we had the liquidation pools. You can always go into my account on YouTube, go to playlists. First of all, you're gonna find tutorials. There's a section, trading tutorials. One of these playlists, I think, is this one in here, that contains 19 tutorials by this time. So there's a lot for you to catch up there to learn. And then there's a new playlist called Advanced Trading Setups, and after this stream, we're gonna add this video as well there. There's 2 videos, episode 1 and 2, and today we're gonna add the number 3. If you need to catch up, you can start from there. Obviously, that one includes everything to do with liquidation pools, which is very important to understand before we can step in today's new workshop. But we need to wrap up order flow and order book before we get into risk management. Any questions that you have, we're going to cover DCA, we're going to cover, let me show you, just to get you, hooked. All of these topics I've got for risk management: understanding leverage and liquidation, risk to reward. We're going to talk about isolated cross margin. We're going to talk risk management tactics, dollar cost average versus stop loss, the pros and cons, taking profits, trailing stop loss, adding to winning trades, strategic DCA orders, not just buy a falling knife, of course, longs versus shorts. What are the fundamental differences that you need to consider whenever you're entering a position, particularly if you're doing DCA on a short? The biggest risk ever of all setups: DCA orders combined with leverage. How does leverage affect your DCA orders? Is it just let's go 100x and let's put some DCA orders? That doesn't make any sense. So considering all of these things, probably in 1 hour, I'm not going to be able to do it. I'm very verbose. I already consumed 5 minutes not doing anything. So bear with me, and we're going to get there. But we need to wrap up order flow and order book. And I left you in the past week already covering a bunch of elements. So we cover CBD, we cover slightly the bid versus ask. So I want to touch base again on that, the open interest, funding rate, order heat maps, and volume profile. So let's get started with bid versus ask. Let's try to go a little bit to the basics again. And typically when you see people talking about the order depth or bid-ask ratio, which are just two names for the same thing, basically it represents how many orders, limit orders, are in the exchange already spread across the price, above the price and below the price. And there are multiple ways of visualizing that data. When you talk about a ratio or you talk about order depth, you're basically implying that you're making a comparison between above the price versus below the price, right? So for example, some people look at the order book just like this, and just with naked eye, they say, we got more orders below the price, we got more orders above the price. But there are multiple considerations. It's not just looking at the colors and getting an absolute reading. And that's where the ratios and the order depth play a crucial role, because by using those, you can definitely quantify what's around the price. And also careful, because if you have an order at the very top in here, very far from the price, and then a lot of orders very close to the price, that also tells you a story, okay? Unfortunately, this information is one of the most manipulative informations that you can use. It tells you sentiment in a way, but always with a pinch of salt, because here is the root of all the manipulation. You can see orders there, but they come and go, okay? There's a lot of, the price goes towards that very strong areas of support or resistance, and then suddenly they rug pull. So you end up getting caught in that idea that there is that strong selling wall or buying wall, but then when you go into that buying wall, you realize that you're cutting butter with a warm knife, and it doesn't really hold at all. So how can we really use this? Well, I guess it's a matter of experience. There's a lot of experience in this. There's a lot of lessons learned. There's a lot of observation and accumulating different scenarios that you went through. Definitely, it's not a black and white thing. It's not something that you absorb the first day that you see, we got support, I'm going to put a buy. That's the way to get wrecked, okay? We don't do that. We don't read it that way. We combine it with other things. It's kind of a tool that once you get other things in place, other things that are strong, like a strong TA pattern that has formed, that shows strength, a strong level of support, a volume profile that shows a historical level, that provides cushion, that, a bunch of other elements, your trend as well. Then when you see this thing confirming a bias, it tends to be better the outcome if it's confirming something else that is already strong. When it's just naked, the number, just because you get a positive ratio or a negative ratio by itself, is a recipe for disaster, in my opinion. So take that away with you and put that massive red note attached to it in the back of your head next time you see this. I never said green on the bottom means a long. No, definitely not. We look at it all the time, and pretty much 50-50. It goes up when there is support, and the other 50% of the time it gets rug pull. So not a great tool by itself. Right. So that's the ratio, and it's got a bunch of more advanced ways of using this. Most of the people out there will look into the depth ratio between 2.5 to 5%. And you need to understand what it means, this percentage. It's very important, because if it's a 10%, it's a 20%, it's a 30%, it's two completely different things. Again, going into the book in here, if we focus into 1% up and 1% down of the current price, that will be a ratio of 1%. Okay, so basically you quantify 1% up, you can make this very granular. Like at the moment I have it in chunks of $500 because it's Bitcoin, but you could do it in chunks of $1, right? and then you get a very, very detailed kind of order book. I don't like it like that. In Bitcoin, I prefer to have it 500 because I really want to see a bit beyond. But that's just my preference. Other people that are scalping might think that 500 is an overkill and it doesn't really provide granularity. Fair enough. For me, I'm DCAing, so I want to see when they place something as far as possible. And I want to see the chunks and the heels in between. That is all important to me. And one way of visualizing is directly from this order book. Set it up like this on Bitcoin. Of course, if it's Cardano, 500 doesn't make any sense. So go with 0. whatever. And then you quantify very close proximity percentages versus slightly further away. And the next thing I do after I look at this, I look at the Hyblock Capital charts in here that give you, there's two charts that I really like that complement different ways of visualizing the same thing. It's still the ratio, it's still the order depth, but is more granular in terms of where is the placement of this. So I keep the 0 to 5 on the top in here. So basically from where the price is, 5% up, 5% below, we aggregate all that volume, all those limit orders from all the exchanges. And you can see the settings in here. We got all these exchanges covered on Hyblock Capital. By the way, there's a Black Friday offer at the moment. The link is going to be in the description on any of my videos. And you can always catch a good discount for a full year. And that definitely helps the channel. I'm not going to deny that. So thanks for that if you use it. So as you can see here, you can control 0, 5%. You can use the full book, which means all end up, all the range up and all the range down. And you can do also something cool, like for example, get chunks from 2 to 5, because maybe you want to filter out what's very close to the price, which could be noise, and you want to treat that as noise. Perfect. And then you can get those ratios and you can apply some filters like more than 0.2, less than 0.15 negative. And those numbers are just based on past experience. So I put the indicator. Sorry, I didn't mean to do that. Let's maximize this. So I put it like this, and I see how it spreads away when there's a lot of support, when there's a lot of resistance, and I look for areas that provide me some cushion. Like this is not necessarily cushion. You need to look into the price plus this, price and this, and a historical level. Like we are in a bull market, and you try to look for something that tells you when we got these chunks, which is roughly 0.13, and you spend more than 2 days there, maybe that's your alpha. We get good, decent support or resistance. That's kind of what I do. You know, I just do it with naked eye, and then I transfer it into this color way of visualizing in the price, which at the moment has the indicator also there overlapping with the price, and I'm hiding the actual bid-ask ratio, and I'm just letting to plot the highlighted colors for my signals, which are at the moment those filters. I mean, you can copy these ones, but next season, if we enter a bear market, you can tell that they need some adjustment because it's getting too noisy, too many signals, too many fake signals. So when you enter into a bear market, or if you are in a long period of consolidation, they need adjustment. You won't find a single number that works for everything for such an extended period, giving good signals. At some point, your signal is going to wreck you. But it's areas to call my attention. That's how I treat this. Oh, look at that. We are in an area of a lot of support. Interesting. And that provides me background information. What am I doing? Okay, there you go. So I do it with this 0 to 5 because most retail are doing that. This is as far as analyst gets. They tend to just use 0.5. They never change the default, and they observe a lot of resistance or a lot of support, and they shout on crypto, and then you get all the herd that never understood what bid versus ask was. They just see green, and you see an account with 200,000 followers tweeting this, and they say, oh, magnificent, that guy must be a PhD, in Bitcoin, and he knows what he's doing. The reality is not. They are just looking at 0 to 5, and that could be just potentially, in best case scenario, 60% good entries for a scalp, and I mean 60% of the time being in profit, and the other 40% getting wrecked. So I also use the 0 to 1. Basically, what I care about here is how are we today, and how are we today relative to the past few days? How has it evolved, this bid versus ask ratio on different deviations? Are we transitioning to trying to contain the price together with some rolling over or rolling up, or are we transitioning in the other direction? Is there a major flip? And so try to close your eyes slightly so you can not see too much detail and see if we are leaning towards getting more into the green or more into the red. And at what deviations? Like, do we have in the immediate close proximity to the price some support building in potentially, or some resistance building in? Is there any narrative in the background driving that change? That's kind of the reading that I'm looking for. For example, in here, there's a lot of caution between 2 to 10%. So 2 to 5 and then 5 to 10. And it's been in green. And today, suddenly, we get this red. So after I identify this new red in there, I can go back to something like a Market Monkey terminal, which also provides another way of visualizing the order book, but the orders are here. You can hover them and see the exact amount, like 670, then increasing into 735 later at a price of 85K. And the rug pulls. This moved from there, it moved in here. And I speculate that this was moved here because it ends at midday, and then at around midnight, and then at 4 a.m. it's moved down. So all of this gives you a sense of sentiment and how the market is evolving and how they're moving the resistance down into a squeeze of a cloud of support. You cannot see the history in here. You just see the snapshot. In here you see the history, and in here you also see evolution in a different dimension, right? Notice, for example, 20% into full book ratio. It's showing that there is potentially a lot of resistance or a lack of support, whichever you prefer. It could be either, because it's a ratio, right? So you go back to Market Monkey terminal, and you could say, you could squash it like this, and then say, where is 20% deviation? So 20% is around 72K. And so from here and below, it says there is not much support. There is not many orders in the order book. It's too far. Yeah, many exchanges don't even allow you to place an order that far from the price. So you will have to have that order from before, and then you can keep it there. But go into your own exchange and see if you can place an order very far. It depends on the exchange. But if you point towards 20%, that is 111. And from here, and the full order book to infinite, it says that there is a ratio that is in the negative, meaning that there are more orders on the top end. So above 111 into infinite, there are more orders. There's more volume in the order book compared to below 72K. Yeah, we came from there, right? We came from 126, and those orders are still there alive, and at the moment are skewing this into 0.34 in the negative. So guys, if you have any questions about this, if you want it in more detail, it's something that I'm missing to explain, just write it down in the comments. Hello, everybody. We have Sam, Seb, Base, and Jose are all there live. It's very cozy. You know, if you really want to learn these things in detail and you want to ask your questions, join Elite and join me and ask me all the questions that you want. All right, so we could say that bid versus ask is completed. CBD, I think I covered it last week. I mentioned that you can get that from Market Monkey Terminal along with many different platforms, and it gives you another ratio. But this time it's not about the limit orders. It's not about what's placed in the exchange. This measures what happens with market orders, which are not meant to go into an order book and wait there for a long time. It's actually the opposite. These are just, you know, give me at any price Bitcoin or sell at any price Bitcoin. And that's for spot, or if it's futures, yeah, just give me market price. And they typically reflect panic because, I mean, limit orders tend to be associated with a strategic thinking. I'm going to place it there and I'm going to wait for that level because that is my favorite level to enter. That's what I'm bullish. I get bullish if we get in 29,500. So that's kind of strategic thinking. But the CBD is telling you another story. It's telling you, I'm going to sell at any price. And price is coming down and CBD is coming down. That means that more aggressive sellers, panic sellers, are taking anything that they get. They see the price coming down and they just continue to sell. And they dominate everything from where we have history in here. We only have history from 21st of October. They've been just panic selling. And yeah, so that's very significant and it hasn't stopped. So take the same reading if it was pointing up. If we were pointing up and we are pumping, and you see the CBD just pointing up, that means that panic buyers or FOMO buyers or beginners are just taking anything. They just don't want to miss the train. And that story is not necessarily bullish, okay? It can continue for a little bit, but more often than not, the market maker realizes that there's a ton of people to get wrecked, that they are just buying any price, and then there is this rolling over effect there, and that tells you also the story that the market maker is passing on their bags into the aggressive buyers, and they're getting just screwed at all-time high, and then they get penalized into 101, 26k down because of the aggressive buying. And many of them are still holding, and they continue to hold, and then this tells you the story of their sad story that they enter at the peak thinking Bitcoin 200k thanks to their favorite influencer, and then in here they start swearing at their favorite influencer. Yeah, what a sad story, but the chart is telling us everything. At the moment, we got longs and shorts piling up into the open interest. And that open interest are positions that are entering. So that's also telling us the story that the longs are still defending. You don't see here longs really stepping back. So they are getting liquidations. They're getting liquidated. The longs in here, for example, on the 10th of October, that was huge. We're not going to get anything that big as that. So I need to put it out of the window to see the normal liquidations because that was just too big. And is compressing the range of the normal liquidations, which are these ones in here. So here you get liquidations of longs, and then you get more longs re-entering as they get liquidated. They enter at lower prices, and they re-enter right here. You get another swing. It slows down, builds a double bottom, and longs continue to enter, and that is not great. I will like that the price is coming down and that the longs are getting just smashed, and they are getting so fearful that they are not willing to re-enter. That will be really bullish. But they're persisting, and I'm persisting too with them, which is not necessarily telling us that we are, in the best position. a best position will be that there is doubts about this across the market. So CBD, cover bar statistics, I haven't covered that, and that's an interesting one. It's not something I use very frequently, but I have it in here because these are the bar statistics. They are available in different platforms. These are the ones, of course, from Market Monkey Terminal, and I really like them. You can configure them what you want to show. You can show sell trades, buy trades, delta, volume, total volume, sell volume, buy volume, lots of things. And there are areas of darkness in here that everything comes down in terms of percentiles. And that indicates an area of interest. The same as if everything is very bright. You should wonder yourself, for example, what happened in here? Well, a huge liquidation, a huge number of things going on in there. So it's an area to make a decision. So it is an area very dark because it's on an extreme of the range in terms of all those statistics. It doesn't matter which ones you pick, but it's basically telling you that there is something going on, fish in there, right? Dark. And and there was a rolling over and then a crash. Not always the case, but it pokes you in the shoulder and tells you to pay attention in more detail. What's going on in here? What's going on with too bright? What's going on with too dark? And I wouldn't give it more thought than that, because otherwise I need to explain every single square inside, which I'm already doing, right? So we are already looking at long, shorts, and all those things separately. The bar statistic, it gives you an overall, keep an eye on that. Net longs versus shorts. This is an interesting one, and I refer specifically, because there's multiple implementations of that. Specifically, I like the one that is applied to Binance in all accounts, and it's counting accounts that are longs versus shorts, and I have two percentages, 70 and 35 are areas of interest at the moment. During the bull market, 70 was very interesting, but there's been a transition as well in here where we cross 70 and price continues to fall. So in a bear market, probably our threshold to find areas to long is going to have to be pushed slightly beyond 70. We already see that. We started hitting 17 here. We put a double bottom, and that play out, it went up from bottom to top around 8%. Okay, good, decent. But then in all this area in here, we went into 79%, and we still don't stop falling, right? This was around 88.7, and we put another 88 around here, and we are still hovering above 70. It's not playing out. So that shows you that you cannot take for granted these thresholds. You have to keep maintaining them up to date with the regime of the market. So I use it in that way. I just keep an eye on that ratio to identify extremes. Extremes of longs, extremes of shorts are always interesting. So around the 30 and below, around the 70 and above, and then obviously with some adjustment based on regime. Open interest, it's interesting just to tell you how much people is allocated in futures, and the more people allocated in futures, the more volatility you should be expecting. And when it's very low, it's also flagging that there's a lack of interest. It could be a weekend. And I also track the aggregated open interest. This one is from a platform called Coinalyze, and I'm going to share it in the chat so you guys can have a look. That's Coinalyze, Bitcoin, and open interest. And I have it set up in this way. With aggregated open interest, these are my settings. So all the exchanges, it covers a lot of exchanges. So it's pretty good. And I use it to identify patterns in the aggregated open interest. Open interest is meant to go up in a bull cycle, and it's meant to go down in a bear cycle. And we are here with a head and shoulders. So I'm very interested to break below the $31 billion. Signifying that we are done. Price has already broken down from the neckline of 108. So that's a breakdown, but the open interest remains persisting to hold the neckline. So very interesting thing going on in there. Typically, open interest precedes price many times. It tends to break out before the price. It tends to put a bullish pattern and do something first. Why is that? Because people enter in positions before the price, and that triggers that the open interest tends to act like a leading indicator. And not always, but many times. In all these breakouts in here, we were very excited to see some things playing out first. And then seeing the price following up, it was very exciting. This breakout and that breakout there too. Now this, seeing a breakdown there, it would have been great to see it before the price. So at the moment, it's telling me the opposite. It's telling me people are still holding on to enough positions in there. So there is a battle going on to hold that level and to bring back the price above the neckline and potentially to go back up. Now, if this in the next 2 weeks pukes and follows the price, invalidation, okay? Then we say, okay, fair enough. Open interest couldn't hold there. The longs that were still battling got wrecked, and we will be probably trading in a 74K once if we see that breakdown there. So that is also more insights on open interest. Funding rate reflects who is paying who. Because when you're holding a long and you're holding a short, depending on which positions are dominating between longs and shorts, one group might be paying the other one. There's always one paying the other one unless it's completely flat for a fraction of a second. But most of the time, it's either negative or positive. And bull markets, you tend to be in the positive all the time. And there are some small chunks of time where it goes negative. And those are considered opportunities to enter in a new long. In the bear market, it's kind of the opposite. If let me see, funding rates. Let's have a look. We got it in here. I'm not sure if I'm gonna see funding rates in the bear market. Hopefully, Hyblock Capital allows me for that. So 2024. There you go, we're getting into the bear market. Oh, yeah, it starts around here. So it really fluctuates in, I will say that it's more leaning towards going into the negative, dominating all the shorts that are in the bear market. In the early bull market as well, but that's when they get all liquidated. It should give you an idea, another way of confirming whether there is too many longs or shorts. Let's see. Oh no, I don't have funding rates, do I? It's very squash. I think there is a bug here. This must be wrong. Probably Hyblock Capital didn't track that properly, or it normalized it in a different way up until here, and then it got squashed. And I look for negative. I have this set up for below zero. That's it. And if it's below zero, I put red there. And then I know it's an area of interest. If it goes too high as well, it's also interesting. That means that there's somewhere a huge long coming in. Next topic will be order heat map. These are liquidation, so I'm going to ignore that. The volume profile, and we are done with the order flow. Let's do it in here. So I use different indicators for this. The volume profile, you can get the one from TradingView. You can find it. I think they used to have it. Oh, they have a shop now here. Interesting. I never saw that before. Technicals, strategies, profiles. They used to have a section volume, but anyways, there's multiple profiles. The ones I use are fixed range volume profile or visible range volume profile. Try either. The fixed range, you select the range of time from this day to this day. Where was the point of control? Where were all the different things? Or visible range. Let's do a chart from scratch. And I always prefer to go in depth with things so you fully understand. The time frame is very important. So whether you're doing 4 hour, you're just gonna see the point of control and the trading range of that small chunk. If you do it on the weekly, you're gonna get a big picture. And I'm actually curious about the weekly. So let's bring in a volume profile. Sorry, let's do it from technicals, profiles, and let's bring in the fixed range, the visible range. So obviously, if I do it like this, a visible range is containing all history on Binance. So I'm gonna get everything. And it should be the same as fixed range, as long as I select the range. Where is the selector? Is at the top. Okay, so if I select that, I should get more or less the same point of control, which I kind of do. They're both at around 19K. But if the fixed range, I only select the current bull cycle, then I also get around 24K. If I do it with the, let's say, this trading range from the pump, then we lost the point of control of 111. That's where we have a massive area of open interest entering with 1 billion, and it could turn into resistance. That's where there is the 200 daily moving average as well. So you can use either like this. I'm using a custom one that someone created. Let me see what's the name. It's called VP. Let's see if they have a link to the actual script so you can find it later. It's open source, volume profile. Is this one in here? The author is KV4Coins. Yeah, and there's the code and everything. I really like it. It gives you the top range, the bottom range, the point of control. Of course, these indicators come with settings, and the same happens to the one I was editing just now, which I now lost. Where is my chart? Here. So this one as well, they have settings, number of rows, ticks per row, so the number of rows that you want to see in there. Of course, we care about a lot of things. So let's go to 4 hour. Let's do it like this. Let me remove the visible range. Let's put it like that. And what do I care? I care about the top of the range, bottom of the range, point of control. Above the point of control is bullish, below the point of control is bearish. And at the moment, breaking down below in here, not reclaiming, is calling for a new range, a new potential incoming range, which means that these two blue lines eventually are going to translate somewhere else. And what else I care? Well, I care about fake outs. Like range trading says that if you exit from here and you re-enter, you somehow eventually are going to get to the bottom of the range. And the opposite, if you reclaim this, there's an opportunity to go to the top of the range. Not always. The conservative target is just to go back to the point of control if you reclaim. But this one couldn't manage to get back into point of control. There was just too much selling and it reached only 107. Remember that everybody was calling for the line in the sand to go into 111. Well, I was calling for 107 because I was seeing a lot of selling pressure. And I said, that's the level we need to break, because that was previous support. Support, resistance, kiss goodbye, boom, back down out of the range. So that is the volume range. Is very important. I use it pretty much in all my videos. Now we're gonna go with risk management topics, but before that, let me see if I got any questions from the elite members from Patreon. What is this? Vinny saying, just came to say hello. Unfortunately, it always collides with customer meeting lately. I just wanted you to know that this on the order flow are amazing. Thanks so much, Vinny. Guys, if you have any questions, I hope that the silence means that I'm already answering all your questions. And it doesn't mean that I'm being extremely damn boring, because I'm having great time. This is my thing. I love talking about these things. If you find me anywhere, invite me a beer and I can talk to you about these things for forever. I seriously cannot believe that, I make a living out of trading and partially as well from these things. And actually, I'm doing better with the trading recently, which I always wonder if I should keep the channel because I'm making more money from the trading. The only reason I keep it is one, because I love making this a social thing. Two, because having you guys seeing what I'm doing pushes me a lot more to be better trader. When I trade just for myself, I tend to cut corners and my discipline really is not the same. Not the same. I need someone overlooking what I'm doing and saying, hey, what are you doing? What are you doing there? And then I pay more attention because I care about what the other people are doing as well. It's something social, definitely psychology. So let's go into risk management tools and topics. This is a huge topic and we have, again, 20 minutes and I'm going to leave you hanging. We're not going to be able to cover everything. In the next session, if you guys vote for next week to do this as well, I complete all the risk management. But it's a big topic. It's more important than entries, guys. Timing your entry, you can... If you have a trade that has a quality from 1 to 100, try to aim for quality 80, 70 to 80% quality entry. Do not aim for 100 because 100 is almost never going to happen, okay? There's a balance. Try to aim for a few amount of things in confluence and overlook a few others. Don't be so perfectionist in terms of your entry. You know where you need to be perfectionist? You know where you need to be a maniac? Risk management. That's where you cannot afford not have discipline, self-control, leave emotions outside, and stick to the plan until the last bit. That is a must. Because risk management is what protects your trade that you might have thought is 100, but maybe it's a 70. Most likely it's going to be a 70, an 80. You didn't see everything. Suddenly there's some news evolving in the background, and then you get a snowball effect of incoming news, or Trump says, I'm selling all my Bitcoin because I hate it this morning. What are you going to do? Suddenly your 80 is 100% entry becomes a 0 quality entry. That's where the risk management must always be. That's where, you get to live another day. So let's talk about it. That's the motivation. I hope I got you motivated on that. So understanding leverage and liquidation, this is not necessarily in any particular order. I just literally gave this to AI, make me a slide and cover all these topics. And it did it automatically. So I didn't say what's the order. Understanding leverage and liquidation. If you don't understand leverage, you cannot use it. So if I ask you now with a hand in the heart, do you understand leverage? Do you understand what it means? If close your eyes, don't ask anybody. If you are on a 5x position, how much the price needs to move for you to get liquidated? If you cannot answer that in 5 seconds, you don't understand it and you are not allowed to use it. No. 5 means that if you move, how much you multiply 5 to get 100. So it will be 20, right? So the price moves 20% and you're liquidated because it's a 5x. You're moving 5 times faster. In a 1x, you need the price to move 100% down to realize the full loss. But in a 5x, just 20%. So do it with 3, do the exercise in the background. I'm not going to do everything. But do 3x, do a 50x, do a 100x. In 100x, how much the price needs to move for you to get liquidated? And give me give me each individual one and write it down in the comments. So I see that you're learning something. So that's very important. And that's just a rough estimate, okay? It's never perfect. Always put a little bit of additional margin, because the exchange is going to charge you funding rates to hold your position, and they're going to charge you for opening and for closing. And it depends also if you use limit order or if you use market order, there will be different fees, okay? And those funding fees and those, management fees. And then if you get liquidated, there will be a fee that is charged before the liquidation. That is a hidden, silent, most hated from beginners, silent killer, because you think you're going to get liquidated when you move 20% on a 5x, but there won't be a single exchange that will respect that at 20. You're going to get liquidated at 17, okay? You're going to liquidated at 19 at best, move down. And if there's a lot of volatility during that move as well, they're going to make sudden miscalculations, and you're going to say, hey, hold on, wasn't I supposed to be my liquidation level at the 19%? And you liquidate me at 16. Sorry, there was so much volatility that we didn't know what we were doing, and we have to take your money. Apologize for that, but sorry, your account got closed now, or something. It's really frustrating, and be, on the defensive side, always with leverage, always over paranoidly calculate things instead of giving room for things to go wrong. Never. So once you understand that, you will start understanding risk management better, because if you do stop loss and you combine it with leverage, it works decently well. If you combine it with DCA, it's a recipe for disaster. And people tell me, why are you doing 3x? Well, that's how I get to survive, and have a good win rate. That is not going to guarantee that I'm going to survive, unfortunately, but there's always risk. It's impossible to kill all risk, but I do my best to mitigate it at least. So on DCA, we'll get to an area in here at the end that we cannot skip. DCA orders combined with leverage. If you are mixing these two things, basically you have two types of poison, from snake and from scorpion, and you're putting it together and you're just downing it like if it was a glass of water. That is what you're doing if you really don't know what it is. For each one of these, we're going to need an antidote, okay? And even if you take the antidote, the antidote, or whatever is pronounced in English, it might not work. Maybe that day you ate something else and it cancels out the antidote and you're still screwed. So be careful. We're going to talk about that antidote later in the video, or next week potentially. Risk to reward ratio. So if I talk about risk to reward ratio, I tend to talk about it in two different contexts. Context number one is when I'm talking about entering versus no entering. So I tend to talk about this when I think about what's the potential upside, what's the potential downside, which is, one way. What's my opportunity reward? Maybe it's not risk to reward. Opportunity versus downside. So I look at all the signals, and I have, a long set of signals, and I say, well, this hasn't failed. This hasn't failed. We are in the buying area, and in these 5 elements, we got 3 here that are still in neutral, and we got 1 that says no go. Okay, so, okay. Should I wait a little bit more so these 3 that are neutral turn also into bullish, or should I enter in here? And how does that compare if I would have entered when the price was even higher, which is even worse? So, and what's the likelihood that the price is going to continue coming down? Like, for example, where we are now in the price, if we look at the price, we are at 90 and we could go into 84. where is our risk? Where are the liquidation pools below? Are we very close to one that is very close to the price? Do I care if I enter a long and if we only take that liquidity and then we start bouncing? Sometimes I make a choice and I say, look, we are trading at 92 or we are trading at 89 and we got a liquidation pool at 85. That's just 4K below. But we might not go there because we are forming already a pattern here. And we are already 10, 15K below my previous entry. Maybe I need to make a compromise and enter with my second order because there is a ratio of risk to reward. If I don't take that long after having fallen 15K from my first entry, I might not be able to average down for a move of 7K up that will get me back in profit if I average down. But if I don't average down, I might miss that exit. And if I average down, we might go to 84 and then I can average better. But you get these two scenarios. Wait for 84 because there's a big liquidity pool there. But what if we don't go and we start coming back up? I miss my exit. And missing exits in a potential beginning of a bear market sometimes is something that you cannot just afford. So you always have to be looking at the risk reward. You always have to be looking at what is my current primarily goal. And in here, my primarily goal was to average down at a decent distance from my first order and try to secure that before we potentially come in with a dead cat bounce or a new all-time high. And that took precedence against my concern that this is not the bottom, because that is just a concern. It's an opportunity to average down lower. But if you see, so it's all about trade-offs. It's all about understanding what matters the most at a given time in a particular potential scenario that is currently checking boxes for a potential beginning of a bear market. We will never know if this is the beginning of a bear market. Never. We will never have a certainty. But if you get too many check boxes, you need to adjust your trading accordingly. So that is risk to reward. And it definitely, there can be 100 different scenarios. Each one will make me talk about half an hour. But, if you really want to continue with this series of videos, make sure that you're writing down below what topics are the ones that you really like. On Patreon as well, my Patreon members can always, push for more things in the elite area of the chat, in the community. You can leave things there and you can just say, Mariano, next week, can we go a little bit more deeper on risk to reward? I want to, some cases of this or that, or, one day I was in this situation and I messed everything up. What could I have done differently to manage it in a more strategic way rather than in an emotional way, which is what everybody is subject to, including myself. Risk management tactics. So I haven't read these things, but let me go into, this is skipping one. Okay, isolated cross margin. Let's do isolated versus cross first. So isolated margin, first of all, in the chat, have you used ever isolated or cross, or have you used both? Which one do you prefer? I want to know from the people here. Let me see. In the DCA section, do you think we could cover the spot strategy for the next market? Yeah, I think that deserves a dedicated video. Jose was already telling me yesterday, we need to start thinking about bear market entries. What are good areas for accumulation and how we can start spotting early a bottoming in the bear market. So we can end. I already mentioned that there is a potential. I'm open for the first time ever for a potential bear market that disappoints the bears, that is not as deep as going into 10K or 20K. which many analysts from the previous cycles, not the new people think that Bitcoin is already too deep. But the people that have been for 2-3 cycles are thinking 10K, 15K. So we need to look into that. Videos are great, by the way. Thanks so much. Never stop the videos. We love the videos. Thank you so much. It's a long process, but slowly I'm picking up everything. The discipline point is super true. That will be great tutorial. How do you qualify an entry, like the checkboxes? I don't have a full list of things. It tends to depend a lot on all my tabs. So if you go to any of my videos, you're gonna see that I stop in different tabs. Those are the ultimate list, and they depend on each timing. Unfortunately, it's not the same charts in the bear market as in the bull market, and not same ratios, not same thresholds. Everything changes. So people prefer isolated. At least Seb Mueller prefers isolated. I play with isolated. Isolated it uses a margin, right? So let's say you enter on an isolated position with $1,000. So you give to that position $1,000. Your account might have 100,000, but you just give 1,000 margin to that particular position. When it's an order still and it hasn't been filled, it will lock down that $1,000 for that position, for that potential position, if it gets filled. You still cannot use it. It's locked down unless you cancel that order. But if the order gets executed, then it turns into a new position, and it's going to start charging you funding fees, and it's going to use the $1,000. Now, if we use 1x, the price will have to go very close to 100% drawdown to liquidate you, because it's also going to charge you funding fees and liquidation fees and all that stuff. So it's not true that in futures it has to go to 100%. It might go to 99 or to 98% down, and you are already liquidated, because they need to account for the additional fees, and that's very important. One second. Sorry about that. There was someone in the door and I wanted to check. So that's margin. If you do 2x, of course, you need a drawdown of 50%, plus the fees and everything. And it only affects the margin. You can add margin to a position. So for example, if you do a 2x and you are already getting close to the 50% drawdown, you can add, not saying that that's a great thing to do, but technically it's allowed to add to a position. Whereas with cross, you cannot really say, I want to risk 1,000 margin in an account with 1,000. So if the account has 100,000 and you select cross, that forces that position to use all the margin that is available in that account, whether it's a USDT margin or USDC, or if it's a coin margin, like if you use your BTC to trade BTC, whatever is the choice, all of that asset that is at a particular time available becomes your margin. And you can add and remove from the account, and then your liquidation level is going to change. So watch out with that. You are in a position, in a losing position, and suddenly you transfer out some USDT from the account. That's equivalent to taking out from the isolated position. So in the account, the cross, that position can get liquidated because you took out some margin of the account. You can add as well, and it's a matter of understanding the risk on what are you gonna do. If you're gonna run multiple positions, if you're really into running 20 positions at the same time, it's very tough to do it on cross, because really you don't know if they are all longs what's going to be the liquidation price, because all the assets are constantly moving and consuming in a different way the margin. So it's really tough to picture where things are going to go wrong. You're probably a degen and you're doing it wrong. If you're doing it with isolated, it's like, in a way, like running a position with an implicit stop loss. Why? Because let me give you an example. You do a position in isolated with a 5x. Let's go back to our example. In a 20% drawdown, it gets liquidated. So that is similar in a way to having a stop loss, because you determine how much margin to give to that. And the more margin you are giving to that position, the more room that position has to go against you. And if you take out margin from that position, you are kind of bringing closer to the current price, that liquidation price. So it kind of works as if the margin was the amount that you're going to lose from the stop loss. It's very similar. Still, some people use margin just for the sake of controlling across the whole account how much they really want to risk. Because remember, a stop loss in rare scenarios fails in exchanges. So many exchanges that people put the stop loss and it doesn't work. So if you use cross and that was Terra and the stop loss doesn't work, despite the fact that you have a stop loss, if it doesn't get executed due to volatility, which is in the terms of and conditions of the exchange, they tell you, sorry, yeah, you use cross. That's why you liquidated the account. Yeah, but I had a stop loss. I remember placing it. Yeah, but there was not enough resources in the system to execute it. I'm sorry, but it didn't get executed. Okay, I want my money back. No, sorry, you signed for the terms and conditions. Bye. And that can happen with cross. With isolated, it's different because they literally create like a mini sub account with the margin, and it cannot go into the other account and take the rest of the account. So that is isolated versus cross. And we need to bring isolated and cross when we talk about the CA again. That's going to make it even more interesting. I want to say it in a positive way. But why I prefer cross? Well, because I'm using the account just the single account, sub account to trade on Bitcoin. So for me, it's kind of equivalent to having an isolated and giving it a lot of margin or doing cross. I don't see it. The way I'm using it, I get the same effect. Okay, so I add to my account the account where I have the long, another account where I have the short. They are not hedging in the same account. They are two separate accounts, and the isolated will give me the same experience. Literally, I will just have to give the whole account as margin, and then use the leverage I want to use, and I will get the same. I don't remember if they have different fees. I don't remember really. I think the fees should be the same. Let's go into the next one. Risk management tactics. So there's multiple considerations in here. We just ran out of time. I wanted to continue talking about this. This is a really, really great topic. What are we leaving on the table? So, because I don't want to run too much beyond the time, because it's too heavy to consume for you guys, more than an hour of me talking about this. But we managed to get into the third topic. So next week, we're going to have all these topics. Jose can take a snapshot of this when we do the next session. So from risk management tactics into here is all for next week as part of risk management series number 2. So if you're on Friday and you're watching this publicly and you want to be part of this series, consider joining as an elite member. Let me see if there's any question before I let you go, guys. I much prefer isolated. Risk reward as in 1 loss to 5 win. Yeah, so that's the second risk reward that I forgot to mention. One is the opportunity of entering, not entering, and what can happen, and what is more important to me at a given time. What is the primary goal strategically for my strategy to get me out of something, or to take advantage better based on the market conditions or my specific bias, what I'm reading from the market. And the second risk to reward is literally what it is. That ratio, mathematic ratio between how much you make if it's correct and how much you lose if you are wrong. And specifically for stop loss. Okay, and when you use stop loss and together with a take profit, and before you enter a position, you define those two things, then you can say, well, if it hits my stop loss, I lose X. Or if I'm an isolated position and I go against me, it liquidates that position, and that's my loss. You see, it's equivalent at the stop loss with the isolated. It can be. And if I win, if you lose, let's say $100, but if you are targeting a 2 risk to reward, that 2-to-1 risk to reward, then you should make $200 if you win. Unfortunately for crypto, trading like that is extremely difficult. Sorry. Why? Because they are chasing your stop losses. And when you put the stop loss in the exchange, it's visible, and it's visible aggregated with all the other stop losses. And if your stop loss lands in an area where there is a hill of liquidity pools, stop losses, or isolated positions, or cross positions, that becomes that liquidity pool. And then you are part of a trap, because you're high likely to attract market makers to push the price into there, to take you out of that position, and to get the price to react in the opposite direction thanks to your liquidity coming out, being forced out. And that creates an effect. And that effect moves the price in the opposite direction, and they take profits from that effect. That's one way of using that. Or if they want to go in certain direction and so many people are already allocated, they want to take them out before going in that direction. So they know it will go in that direction, but they want to go less heavy. They want to take some people out of the bus, and then they want to fill the bus with all their family and friends. And then the bus goes in the direction that was supposed to go. So that is risk to reward, the second interpretation. All right, guys, this is 10 minutes over the time. Thanks so much for watching. Thanks so much for all your questions. I hope you enjoy the workshop, and I'll see you next Thursday at the same time with the other topics. Bring in your questions. Bring questions about the leftover I have here in risk management, and we can cover them live. And for those of you that haven't joined Elite, join Elite, okay? That really helps the channel as well. See you in the next one.